Welcome to the second part of the tutorial, and in this tutorial we're going to continue from the statement of financial position statement, which we used to call the balance sheet. So now under this one we have the table or the layout where you have particulars, the cost, the accumulated depreciation, the net book value. So the cost, let's say if you buy a phone at 7,000 kwacha, after some years of course it's going to depreciate, meaning you're not going to sell that phone at 7,000 kwacha. So that amount of money at which this phone has depreciated, maybe 4,000 or 2,000, that becomes the depreciation value, meaning you're going to put the cost of the phone in the cost column. Then this discount which you're giving someone, that one becomes the depreciation. Then the amount of money at which you are selling this phone, that's the net book value. So that's the easy way of understanding what these cost, accumulated depreciation, and the net book value mean. So now in this case, the first, according to accounting equation, you have assets is equals to capitals plus liabilities. So you can have non-current assets here as one type of an asset, because we have got two types of assets, like current assets, non-current assets. Yes, there are two types, current assets and also non-current assets. So those two types, you can have the first type here. So under current assets here, according to this question, you only have office furnitures. You have office furnitures. So the office furnitures has been given at cost 200,000. So the office furniture, according to the question, saying office furniture is at 200,000. So the accumulated depreciation, we add this one, this figure which is the office furniture, 80,000 plus the amount that depreciation we found of 40,000. So 80 plus 40,000, 80, say 80 this one. So 80,000 plus 40,000, you are going to get 120,000, like that. So this is the depreciation, meaning you're going to say 200,000 minus 120,000. Just this one minus 120,000, and you get the 80,000 as the net book value. Then you go on, you have delivery van. That's the other non-current asset you have, the delivery vans, and the cost of delivery vans is 270,000. So delivery vans, we found the accumulated depreciation in the question when we calculated it was 43,200, this one. So this 43,200 we are going to add with the 54,000 which is here. So 54,000 plus 43,200. So you can say 54,000, we add 43,200 and find the answer. Which we're finding as 97,200. So 97,200 there. Then we can say this is also the depreciation. So meaning we're going to say 270,000, 270,000 minus the 97,200. And we get 172,800. Now we can balance this. We find the total non-current assets. So we have 200,000 plus 270,000. Find the answer there. Then you can also say 120,000 plus 97,200, get 270. Then you can say 470,000 minus 217,200, which is just the same as saying 80,000 plus 172,000. You'll still be able to get the same figure here. Then from here we can go to current assets. So under current assets, we've got the first one is inventory at 31st December 2020, which in the question has been given down there because it's not in the trial balance, so it's supposed to be down. Inventory at 31st December 2020, 429. So I put 429,000 there. Then we go on, we check which other assets, which other current assets we have here. We have got cash, 9,000. So I can put cash, 9,000 there. Then in the additional information also we have prepayment, rent prepaid, 18,000. So you can put prepayment there. In the prepayments account we have got rent, which is 18,000. Then we also have accounts receivable. So receivables, we have been given the figure which is accounts receivable 1,191,000. Then we have also been given allowance for doubt debts 66,000, but it has increased to 81. So we say less allowance. So less allowance for doubts debts increased to 81,000. So we less. So this figure we're going to highlight like that since we're saying less. So 1191 minus this 81,000, 1,010,000. So we just check to make sure that we haven't missed any. Just confirm here. Actually, we haven't missed any. So now we can proceed and add the assets. So we have 429 plus 9,000 plus 18,000 plus 110,000. 1,110,000. So I have 1,566. That's the total current assets. So this figure we add to the total non-current assets and find the total assets. So say total assets here. So you find the total assets there. So you say equals the total non-current assets plus the total current assets. We find the answer, which is 1,818,000. So that's the total. Now we can go to the capitals. Let's put financed by there. So this is where the investments are. So capitals, we've got capital at 1 January, capital at 1 January 2020. So let's check how much is the capital at 1 January 2020 as the business started. Here, 720. So you put 720 there. Then you add the net profit which we just found. So add net profit. So we add net profit there, which is 316,800. 316,800 there. So we add these two. So you have 1,036,000. Then you less the drawings. So you less the drawings from there. So the drawings have been given as 288,000. 288,000. So we highlight this one since we're saying less, and we find the capital at the 1st December 2020. This is the closing capital, of course. So it's 1,036,000 minus 288,000. We have 1,008,000. Okay. Then we go to current liabilities. So under current liabilities, you have wages and salaries accrued. So you can just put accrued expenses. We have 21,000. Then you have office expenses owing. And the figure is uh, 288, 123, 748. That was a mistake. Okay. Office expenses owing is 2,000. After that one, we have got bank overdraft. Bank overdraft has been given as say 435,000. Then we have payables, accounts payables. go to payables, we have accounts payables 612,000. So check, we just make sure that we haven't missed any owing accrued. Okay, it's there. Bank overdraft there, but okay, accounts payable. Okay, everything is there, bank overdraft and everything. Then we can add. So we add the figures we should have here and the current liability. A reason why we haven't added non-current liabilities is because we don't have any non-current liabilities. Under this section, we can have debentures, mortgage, or any long-term investment, such as mortgage and any long-term loan can be here. So now these two figures, we can add them to find the total equity and liabilities. So total equity and the liabilities. So total equity and liabilities is the total which we're going to get here. So we add the total liabilities is D75. 1,818,800. So these are the same. The assets and the liabilities, also the assets, capital and liabilities are the same, meaning the equation is balanced. So this is about the income statement and the balance sheet. So thank you very much for watching.